The relentless bull run continues with the S&P 500 and Nasdaq both recording new all-time highs as Jerome Powell testified on Capitol Hill. However, markets did come off their highs intraday, and it all had to do with some of the words that Jerome Powell said. Now, what exactly did he say? Today, I'm going to report everything about the markets, Jerome Powell's testimony, and the effects it'll have on stocks for the rest of the week. We're also going to talk about the likely outcomes for the S&P 500 heading into the election, volatility, and why this chart is the reason the S&P 500 continues to make new all-time highs. And of course, BofA's institutional research. 78% of fund managers look at these technical charts from BofA every single week, and today we're going to do a deep dive into the exact same charts. What are BofA's key levels, and when do they see the Ponzi scheme come crashing down? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. So if you like this video, please subscribe, hit that notification bell. Guys, like this video please. It really helps me out. Leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and something that's completely glaring to me is technology infrastructure. Microsoft down 1.44%, Oracle year as well, and that's because Elon said he's no longer going to be using Oracle for his XAI ventures, down 3%. And this entire sector fell as a result. So very ugly action in this sector. We saw quite a bit of red here in semiconductors, but not equipment manufacturers. They were actually green along with Nvidia, and that did push semiconductors slightly in the green here today, despite what the broader semiconductor market did. Apple gained 0.38%, very close to that 3.5 trillion valuation. Kind of nuts to see how big this company is. Google, Meta, Amazon were flat. Tesla up another 3%. It's probably going to 300. And then we saw very green action here in financials, excluding Visa, MasterCard. They were down. Financials were very green after Powell's testimony, and we're going to talk about that later. But all in all, there was no real leader today. I mean, look at the top performing sector. It was like XLF, KRE. Okay, so financials, sure. Then we had stuff like healthcare, discretionary, communication services, utilities. So we had cyclical sectors, rate sensitive sectors, defensive sectors. We had some of the big tech names up at the top, and they all outperformed the SPY. But then we actually look at what lost today: technology. XLK down 0.08%, software down 1.59%. The commodity sectors, XLE, XME, industrial. So there was no real leader today, but the market did take a liking to large factor sizing. Large value, large core, large growth outperformed mid caps, outperformed small caps across all equity factors, whether it was value, whether it was growth. So something you can take is that the market definitely postured into the larger cap names, and we saw that here with the IWM down 0.44% and the S&P 500 and the Nasdaq both equally up 0.07%. You can actually see that they were up much more at the start of the day, and as Powell's testimony came out and as the day of trade evolved, we actually moved down. What was very interesting is that the RSP, this green line right here, actually opened negative on the day, moved all the way up to actually be the best performing index. And then actually we tempered gains towards the end of the day. We'd actually underperformed the Nasdaq and the SPY. So very volatile day of trading. We saw the IWM literally go from like down 0.8% to in the green to finish the day off down 0.44%. But definitely a day for larger cap names versus mid caps versus small caps. And bonds took it on the chin as well, because yields actually rose after Fed Powell's testimony. Yields rose 0.42%. The dollar gained as well. And there was no real rhyme or reason as to why yields actually rose. I mean, Fed Powell came out, spoke on Capitol Hill, and he didn't really say anything we didn't know. He said stuff like, we expect it will be appropriate to reduce the target range of the federal funds until we have gained greater confidence inflation is moving sustainably towards 2%. The recent inflation readings, however, have shown modest further progress. More good data would strengthen our confidence. And he also talks about that their dual mandate is not just inflation now, but also the labor market, so they are paying attention to that. And if they do see it weakening, then they might cut. So nothing crazy that Powell came out. He just towed the party line. What was interesting was what Powell said on financial regulation. He pretty much told lawmakers that a set of revised regulations was going to be reproposed. Financials really like this. There's been a big talk about financial regulations, and the talk has been pretty much easing financial regulations in the financial sector. So to hear some of this is part of the reason why we actually saw upbeat action in regional banks as well as XLF, the financial sector as a whole. Now, after Jerome Powell's testimony, crude fell 1.12%, coming off its highs it made here at $84. It does look like downside risk is going to persist, but expect to find support at the $80 level. Silver was pretty much flat on the day, balancing at the highs here at $30. Gold did slightly better than silver, up 0.22%. Growth outperformed value, and the IWM, RSP, mid caps, and the S&P 600 were all red on the day against the S&P 500, which was pretty much flat on the day. But looking at the S&P 500, this is another new all-time high for the S&P 500. Although if we dive into the 5-minute chart, we can see some very, very glaring things, right? We actually did gap up, and then from that gap up, we actually did move lower. So yes, a red candle. However, the day was still green on the daily chart, as you can see right here. And we pretty much found resistance at the 5592 level. We do know that the 5600 area is the call gamma resistance. It remains the call gamma resistance currently. And that's where we're definitely going to find resistance in the market, the 5600 leading into the June OPEX. And this is probably going to be the high. We might wick above it, sure, but it's probably going to be the high of the month of July. From here, there's probably asymmetrical downside. I'm not saying we're going to fall apart. I'm just saying that 5600 is likely the high unless we actually get the call gamma resistance move up. I don't think that's going to be the case. I think we're going to stay at this 5600 into July's OPEX. So from here, probably can see a little bit of downside, maybe a little bit of upside action to the 5600. Sometimes we do get a bit of price discovery, 10-15 points above, but probably a bit of downside price action into the July OPEX, into the end of July is probably the likely outcome here in the S&P 500. And that could probably come with stuff like, you know, mega caps, maybe trading sideways, maybe even trading down, with the broader market stuff like the IWM and the RSP going on a bit of a run. And then we can actually still see the markets, you know, kind of trade sideways, trade flat to down in stuff like the S&P 500 as a whole. But overall, the market is still bullish, and you do want to be buyers of dips. Now, let's assume we do get a pullback in the S&P 500. What levels should we be looking to buy? And the very first level is just the 5500. That should be, you know, the first level we want to be buyers of. And then the next level is just the gamma flip zone, which is around here, the 5450 level. It's a little bit higher than that, but you know, somewhere in between these two levels right here, 5450, 5500. This is really where you want to be a buy. Upward price momentum, because I do think that we are going to see further upward price action in the markets through the end of the year. Now, can a deeper correction come? For sure. Let's say we are to get below the 55 area. I do think that we can actually see a deeper pullback. And if we do break this 5450 area, I think we're going to go to like the 5200 area, which would represent an actual pretty big drop. I think we go to like probably like this area right here, somewhere here. I think we go to like the 5224. We could maybe go to as high as the 5250, possibly as low as the 5210, 5200, but somewhere in this zone right here. So this is what I see the S&P 500's price action over the next couple of weeks. We probably going to see downside if we do pull back, find support here at the 5500 area. Then we could buy those dips, look to higher prices, look to the 5600. If we get the call gamma resistance move up, look to 5700. If we break the 5500 area, probably find support here at the 5450 area. And then we can look at the same targets, 5600, 5700, wherever the call gamma resistance repositions itself. However, if we do break below this 5450 area, right, then I would say we probably see downside all the way to 5250, 5200 area, where I think longer term bulls will come in a very strong way and support price action to the upside, and then we could look back to new all-time highs. And the reason why this is such an important level is because we use it as resistance right here, and we used it as a support line for this breakout we saw in the S&P 500. So it's a very, very key level. Now, I'm not saying we are going to get there. I'm just saying this is the likely outcome if we do go ahead and break that. And that's what a lot of my models are saying. My models right now are saying that below the 5450 area, there's a bit of downside weakness we can definitely see in the market. We use it as strong resistance right here, but if we do break below, we are going to move lower. That being said, do I think it's going to happen? Most likely not. Not this month in July. Not while there's so much positive gamma in the tape. I do think that all dips will get bought. But in the window of weakness, you particularly want to pay attention to this price level in the window of weakness. If the 5450 area gets broken in the window of weakness, right, then we can definitely see this level right here. But all in all, when we actually measure it out from where we are right now to there, it's only a 4.7% pullback. Let's just call it a 5% pullback. I guess on a peak to trough basis, you know, it would be something like a 5% pullback. To the lower levels, it would be something like a 6% pullback. So it's not anything crazy. It's not even a correction. It's not even a 10% correction. It's just a minor pullback that we can look to buy the dips in the market. So that's what I'm thinking of the S&P 500 over the next couple of weeks. Expect some short-term volatility here. Maybe we do work off some of the short-term overbought conditions in the RSI. We will find support at the 5500, 5450. And if we do get below the 5450, expect sell side to as low as the 5200, maybe 5250, you know, sort of like this area right here, where longer-term buyers will come in, and then we can go ahead and attack new all-time highs. Let's talk a bit about sentiment. And this is something we do in this community every single week. On a Saturday or Sunday, I release the sentiment poll. And I just asked the question this week for the S&P 500, are you bullish, bearish, or neutral? And for this week, 59% of you guys were bullish. Absolutely insane. I think this is the biggest I've ever seen bullish sentiment in a single week. Bearish sentiment at 26%, neutral votes at 15%, and 612 of you voted. Thank you so much for voting. And I don't blame all of you that are bullish, because we haven't seen a single 2% down day since before the SVB crisis. And the price action we're seeing now in the S&P 500, very minimal volatility, stair step higher, all dips getting bought. Corrections are far and few between. It feels very mid-cycle. And in a mid-cycle environment, you want to buy tech, you want to buy finance, you want to buy industrials, you want to buy cyclical stocks that outperform in a strong economy. And these are the stocks to own: tech, finance, and industrials. The stuff you don't want to own: basic materials, utilities, telecom. So essentially defensive sectors. Mid-cycle is very, very risk on. And again, tech, finance, industrials. And these are the sectors you want to own, because all dips get bought, and we normally just keep making higher highs, new all-time highs in a mid-cycle environment. Now, looking at the S&P 500 on a much more shorter time frame, this is the performance from the 8th to 15th July, when the trailing quarter is up at least 5%. Nasdaq returns, S&P 500 returns, and we normally see average returns of 2.03% in the Nasdaq, 22 wins, 2 losses, 1.47% in the S&P 500, 17 wins, 2 losses, which means the next 7 to 8 trading days tend to be very, very bullish in the context of what is normally a very bullish period for an election year. June, July, August tend to be the most bullish 3-month period in an election year, returning 1.3, 0.7, and 1.3% respectively. And then we normally see volatility in the September, October, November timeframes, and this is because it leads up to the election. Historically speaking, volatility increases as the election nears. Normally in October and November, we do see quite a bit of volatility, but once we get election certainty, we normally brush that volatility off, and it's up, up, and away. Now, the reason why equities are rallying here in 2024 has to do with earnings. You can see that in 2020, 2021, earnings moved very big to the upside thanks to government stimulus because of COVID. And since then, the S&P 500 earnings growth has pretty much been flat for 2 years. But from 2024 pretty much all the way into 2027, analysts are expecting huge earnings per share growth for S&P 500 companies. And this is not just in the Mag 7, this is broad-based earnings per share growth. And the second we get this type of growth, equities rally. And at the same time as earnings are expected to come in very, very strong, margins are also improving. Now, this is only margins for the next 4 quarters. This is where we are right now. This was the peak in 2021, and we're getting back to those peaks. We're looking at 11, 12, possibly as high as 13.1% margins in the second quarter 2025. Now, this is next 12 months EPS expectations. So this is what the market expects 2025 second quarter earnings to be. So if all is well, we should see a huge uptick in margins, and in an environment where margins are improving and earnings are growing, you want to hold equities because they tend to do very, very well. Equities can blow your socks off in an environment where profit is increasing and those margins are increasing as well. Now, let's talk a bit about the macro. The Fed's GDP now for Q2, which essentially just tracks the outcome of Q2 GDP, sitting at about 1.5, 1.4%, a stark move down from the highs at the start of the quarter. And actually, the Fed's GDP now sitting below the blue chip consensus, which is at about 2%, sitting near the lower end of the blue chip consensus. So very, very interesting right there. We're going to see how GDP holds up as we get CPI data this week. Now, similar to the Fed's GDP now, we also have CPI now, which tracks CPI in real time for those of you that didn't know. And right now, CPI now is sitting at 0.07 for June 2024. And this is partially where people like BofA and the consensus get their expectations for the month-over-month CPI figures. You could see the consensus is 0.1, BofA is at 0.1, and the CPI now figure rounded up is at 0.1, currently sitting at 0.07. So the expectation is 0.1. That would mean disinflation is in progress, which is what the market dearly needs, because in the last 3 months, economic data has substantially weakened. This is Citibank's Economic Surprise Index, the United States, and the global economy. And in the last 3 months, economic data has substantially weakened. If disinflation were to stall, the economic data were to continue to weaken, we could actually have a stagflation scare. So if weaker economic data is to persist, it must at the minimum come with disinflation at the analyst mean, which for CPI this week is a 0.1% print or better. But Goldman actually gave us their full economic outlook all the way into 2027. And I just want to look at the 2024 as well as 2025 stats because things are looking very interesting. While GDP is expected to come in anywhere from 1.4 to 2%, if you look at maybe what the Fed's GDP now is saying and the blue chip consensus, Goldman expect 1.8%. However, that weaker figure should improve here in the third and fourth quarter with expectations of 2.7 and 2.5%. But the most impressive thing that Goldman expect is actually on the labor market. You could see that currently the unemployment rate is at 4.1%, but they actually expect this to decrease to 3.9% and 3.8% in the third and fourth quarter on the back of payrolls coming in at 175,000 every single month. And if we are to see the unemployment rate move lower, inflation move lower, and GDP to remain robust, that is an exceptional backdrop for equities, the economy, and the market as a whole. And if you actually dive into the second quarter stats here for 2024, you could actually see from GDP to the labor market to the inflation numbers, as well as the housing stats, the second quarter was always going to be the weakest quarter of 2024. And then we see improvement in the third and fourth quarter. And if the improvement does continue as we think in terms of growth remaining robust, the unemployment level falling, inflation moderating, and we actually do get the rate cuts to normalize policy, that is going to be an exceptional backdrop for the economy as a whole, companies, growth, the stock market, and everything in between. So let's dive into some charts. Now we're going to look at some technical charts. Now these are charts that BofA draw up and I show them to you guys when I get access to them. The reason why we look at these charts specifically is because 78% of fund managers have access to BofA's private research. And that means we're looking at the same charts that smart money are looking at. And it's an edge that we can extract from the market. Now this right here is the S&P 500 weekly chart with 40-week and 200-week moving averages. Now BofA say they can see a cup and handle right here, a breakout above the cup and handle at this point. We broke out above. We attempted a retest at the 49.53 and have since moved all the way up, breaking the key levels of 53.40, 54.40, and now the next upside targets take us to 5600 and a measured move from the bottom of the cup to the top of the breakout above the all-time highs at 48.19. That would take us to 6150. That is their ultimate upside target, probably into 2025, maybe the middle, maybe closer towards the end of 2025. But with the way equity markets are traveling right now, we're going to see 6,000 by the end of 2024. Looking at the Nasdaq, very similar situation. We can see a cup and handle, a breakout right here. We broke out, we retested at the 17,000 level and have since moved all the way higher, breaking the key levels at 16,000, 17,000, 18,400, 19,400, which means the next upside targets are 21,200 and ultimately the 23,000 level. Now the IWM, a little bit different. We've seen this massive correction in time and we're trying to have the breakout in the Russell. Our breakout would look like if we broke above the 208 to 212 level right here, break above, retest, and then move higher. Upside targets would take us to 234, new all-time highs 244, and a measured move above the breakout on this high right here would take us to the 260 level. And lastly, looking at liquidity conditions continue to be a net positive year for the US. We actually did just move into the puke zone, but we're still in the bid zone, and the Eurozone has saw a massive uptick in liquidity conditions in the last couple of weeks, back above the bid zone, which means for both these markets, the United States, the Eurozone, so you're looking at stuff like the Stock 600, the CAC 40, the FTSE, the DAX, the S&P 500, the Nasdaq, the IWM, liquidity conditions are a net positive for these markets.